Um, where do I point this? Can you tell me how to move this forward, please? Or could you just go to the next slide? We are a fund. We have about $500 million under management, a team of 18 people. We invest only in technology. And we've got a portfolio now. Which one? Huh? Oh, this one. Excuse me. Which one? Yeah. Okay. When I say, can you please turn to the next one? So we've got about 70 companies under our portfolio right now, all technology ventures. We've done 19 exit transactions in the last 3 years overall. So that's really us, a team of 18 people spread across Delhi and Bangalore and Bombay. Next, please. Could you go to the next slide, please? Some of our companies, CureFit, FirstCry, Flipkart, we were investors after the early rounds, Lenskart, and et cetera. These are some of our portfolios who are leaders in the market space. Can you go to the next slide, please? So effectively, what's our belief is that exits happen rapidly only with companies scaling. Fundamentally, exits can happen in 3 scenarios. Secondaries, it can happen through public markets, it can happen through M&A. If we look at the history of exits in the country, a few things have to converge. One, it takes 6 to 8 years for early stage companies to go to a reasonable size, but to a exitable high return size, it takes 10 plus years in India right now. That's a long, long time. So effectively, one of the reasons why we did not see many exits earlier was because the companies were not scaled enough. Yes, there were smaller transactions taking place, smaller to the extent of M&A mostly. However, if you look at the kind of investments which are taking place in the industry today, in the last 3-4 years, PE, VC industry investments are actually rising. Last year was a very nice number of 26 billion, and that was on the basis of exits happening previously. More investors come in because more exits are happening. It's also supported by the fact that there is a groundswell of innovation taking place in the market. Innovation, we invest in technology, so we see a lot of innovation. I remember when we started 12 years back in India, when I formed IDG Ventures, in the first quarter, which is the last quarter of 2006, we saw 65 new companies. Right now, we see about 3,000 a year. So there's a groundswell, and the number of new companies we see every year. So there's a groundswell of entrepreneurship, which is supporting capital coming in. And as companies grow, you also need large pools of capital to support it during the course of the life of a company. So effectively, more capital coming in is good, and more late-stage capital coming in. Tech used to be, as recent as about 7-8 years back, about 12% of all private equity. Today, it's 46% of all private equity. We believe technology will go in the next 10 years to about 60 to 65% of all private equity investments in the country. Why am I insisting on this as a good thing? Is because tech enables you to build companies at a faster pace and build value which is disproportionate to just plain revenue. That can only happen in tech over a period of time. So I think these are the trends which are sort of coming together in the Indian market space. And I would say the last 3 years, if the gradient of venture tech investments in the country has been about 30 degrees, in the next 5 to 6 years, I see this as 70 degrees. There is a phenomenal change on the ground which is happening. Interestingly, Walmart coming into Flipkart is a game changer, and just because of that, you see large pools of capital and other exits happening as such. Next, please. I think the other thing is, which is also generating a lot of interest right now is, the fact that our GDP is coming back. Interestingly, the VC investments as a percentage of GDP is about 0.06% right now. This is growing to 0.08% as per a public Morgan Stanley report. However, I do believe that if all the confluences are taking place in the right manner, I do believe this 0.08% will increase. I mean, fundamentally, India has to grow. The large population, young population, all the macro is right. Political, up and down, bureaucracy, up and down. But if we continue to do well, we believe that the exits will rise. The reason why exits will rise is because investments are rising. Fundamentally, the growth patterns of a company are rising. And I'll give you one example. We invested in Myntra in 2007. The revenue of Myntra at that time was 12 lakhs a month. We divested, or rather sold it to Flipkart in 2014 March, and the revenue annualized of the company at that point was 600 crores. So it took 7 years to reach that level. Mukesh Bansal, amazing founder, he started CureFit. So we are the first investor in CureFit, and right now CureFit is achieving that scale of 100 million a year in 3 years. So this is because of, obviously, the entrepreneur. This is because of the scale possibility. India is enabling scale of consumer companies at this moment at a pace which I believe is at least 2 to 3 times more than what it used to be. And that I have never seen, which means, is it possible to build a large company in a shorter time frame? The answer today, I think, is yes. Next, please. So, as portfolio grows, so do exit. I think that's the paradigm which we have believed in and we continue to believe in. Tech companies have started slowly tapping the IPO market. I think the IPO market, in our case, about 8% of our exit profile is through IPO. But I believe in the next, I would say 5 years, don't be surprised that technology companies on the public markets will be anywhere between 10 to 20 going public. So I think that's the paradigm or the narrative is also very important. Investors did not believe earlier that Indian IPO market is something which they will tap. I think in the last 3 years, investors have started believing that the Indian IPO market is something which they want to tap. And that's a shift in the mindset of investors. The emergence of late-stage capital has given rise to a very healthy secondary market, and I'll come to that a little bit later. In the food chain, seed, VC, PE, and growth, you need very large amounts of capital in PE and growth. During the 7 years we were invested in Myntra, capital raised was about 125 million, capital consumed was about 101 million overall. But if you look at these, and I'm not counting Flipkart at this moment here, but if you look at some of the other companies which are there, consumer companies, if you want to scale them to a large number, and they're extremely capital efficient, you still need between 150 to 200 million to scale to that level of market leadership, and that's a number on the lower side. So if companies have to scale, you need capital investors in the tech space who can put in chunks of money at 50 to 100 to 150 million. And that, I think, space, there are a lot of people right now. So there's no dearth of capital in that space right now. And that has changed, obviously, in the last 3-4 years. I think, and somebody used the word sonicons. I like that word because they are unicorns about to happen. We have a number of so-called sonicons. They're companies who are doing extremely well, and they are in the process of scaling to a level where they could be valued at $1 billion plus. Today, if I look at some of our own portfolios or some of the other investors' portfolio, I believe that number, we have 11 or 12 unicorns in the country today. That's very, very small. But in the next 5 years, don't be surprised, another 20 to 25 grow to a scale where they are leaders and valued substantially higher than what they are today. So these are the confluences which are happening in the market. But let me share with you some of the players in the capital market who are enabling exits to happen, especially in the secondary. And I believe secondary is a phenomena which will lead a number of exits higher than IPOs and higher than M&A. Next, please. And these are some of the names which are here. So effectively, private equity players coming in the late stage of the life of a technology or a non-technology company with check sizes of anywhere between $50 to $200 million. That obviously means that the asset has to support that amount of capital. There has to be a need of that amount of capital. They have to be market leaders, and there has to be technology which is disrupting. The number two player should be far behind. I mean, it's literally capital coming in almost in a perfect world, because the number one leader has to be almost perfect as such. We have seen that the appetite for such companies which are emerging is growing. There is enough capital in the market for good companies at the late stage overall. And interestingly, there are Indian players who are now emerging. Indian players like Jio will be very, very strong. Today, they are not acquisitive in nature, but my belief is they will become acquisitive in nature. Indian players like Premji Invest are very large pools of capital, and they are hungry for more good companies, consumer and software, to invest in overall. They're long-term stable capital overall. And I believe we'll find more pools of capital. We ourselves raised almost 40% of our fund from India, and I believe that Indian capital will start playing a very large role in exits, whether they are small or big. So secondary exits, to my mind, are leading the way and will continue to lead the way as far as VCs are concerned. Next, please. Some of the, again, hopefully all the numbers are right, but you see a sequence of exits which have happened, and these are a combination of secondary, these are a combination of M&A in the market space, and a few IPOs. If you look at the large ticket acquisitions which have taken place, they are large Indian companies buying number two players. We in FirstCry bought from Mahindra's Mom and Me, which was later Baby Oi. It was a large transaction. Today, number one players gather a phenomenal amount of capital, and number two players are finding it hard to get capital. So effectively, it's an ideal situation for number one player to buy the number two player to increase the reach of that number one, the market share of the number one player. And I believe that's going to happen more and more. Interestingly, Myntra was number one in the market, bought by Flipkart, but Flipkart bought Jabong as an aggressive measure so that Amazon could not build the fashion side of e-commerce. So you will find such moves also taking place in the market as leaders grow. I think, again, the presence of large Indian players is something to talk about, whether it's a Flipkart or an Ola. India is an open market. India has international players who are right there from the beginning, whether it is an Amazon or an Uber, et cetera, et cetera. There are two ways to look at this. The presence of international players disrupts the fact that in that space, like in China, you can't have Indian entrepreneurs. There is a positive side to it. The entrepreneurs who have built large companies in the face of international competition in India have actually built superior companies. You find the likes of Paytm or Ola going international. or FirstCry or Lenskart, because these companies are large enough either to match the might of international players or to ensure that it becomes extremely costly for an international player to come to India. If Warby Parker has to come to India, they have to be better than Lenskart. Lenskart has a market share of something like 65, 70%. So will they be able to match the cost? Will they be able to match the reach? Will they be able to spend $300-400 million in the country to build a parallel to Lenskart? It's a tough one. So some companies who have built verticals in the consumer space have built it in such a way that international players may find it very tough to come in. Some companies like Flipkart, like Ola, have built companies which are fighting neck to neck with the international players, and to that extent they're proven to be better. I see those companies buying number two players much more. I'm not too sure the international players are right now sort of attuned to buying in India, because I think the decision making is probably outside the country, and to that extent they may lag a bit overall. So there is a history of emerging exits which has taken place over the last, especially over the last 3 to 4 years. Some of us are returning capital every year to our investors, which basically means VCs will start, who are returning capital, will start raising capital more frequently. Cycles could be as frequent as 2 years, invest at a higher pace, and exit at a higher pace. That cycle to me has started. And that cycle has started in the last, I would say, 18 months or so. You'll find more Series A capital, you'll find more Series B capital, seed is already there, and you'll find more late-stage capital. It's a very interesting phenomenon. I'll give you the negatives also, but this is the positives right now. Next, please. I'll share, and as I said, secondary, then I'll sharing with you our exit profiles. 57% of our exits have been secondary, IPOs 8%, and M&A 35%. Our belief is that at an industry level, secondaries will continue to lead. M&A will be lesser, and IPOs, I think, will rise. So this chart 5 years from now could be M&As lesser, IPOs at least in the 20% range, and secondaries much higher than 57%. Let's see what happens. Next, please. So I think in summary, we are talking about Indian funded entrepreneurs scaling more rapidly. The Indian market is enabling that to happen, and that will give rise to all three kinds of exit which I spoke about. It's our belief that at least $150 to $200 billion worth of capital India will absorb, and that's a phenomenal number. But it's more important, from the minuscule less than 5% of that capital being rupee, I think rupee capital will start playing a much bigger role in the country. China, local capital is as high as 50 to 60%, and I think that plays a very important role. Industries in India, traditional industries are not still bought or wet their hands in the tech space. I think they're looking at it, whether it is the Mahindras or the Godrej family, or you name the groups which are there in the country. They have all seen technology pass them and entrepreneurs building large companies. Jio is the only group which is strong in the country. I think you'll find another 10 odd at least coming in the next 5 years. And that's a phenomenal game changer for India overall. Interestingly, I did not know, but I believe VC exits are already, VC tech exits is already at $1 billion a year right now. And that's very healthy. Indian investors have started, getting exits. And that's very healthy right now. So effectively, that scaling up will happen. What are the cons of this? Investors will be wary about, with all this capital coming in, valuations at the early stage rising. I think we'll all be wary. That's number one. Number two is international capital will face the fact that a large part of the returns in a fund life, 5 to 6%, could just vanish because of rupee dollar losses which are there. Rupee as today is at its highest at 69 to 70 rupees. And I think all of us are worried that it will go higher, which will hurt international capital coming in. So if international capital comes in at a slower pace, you will find rupee capital is not taken over yet. So there'll be a gap then. So I think these are the two major, I would say, cons in the market as we look at the industry returning more capital, and more important, entrepreneurs building large companies and returning returns to investors. With that, thank you very much. I'll be happy to take any questions.
Ladies and gentlemen, the house is open for questions.
Thank you very much for this, Mr. Sethi. This was most useful. You know what I'm also seeing, since you mentioned the exit trends today, and the large exits are also coming from corporate buy-ins, particularly if you look at the Flipkart Walmart case. I mean, the eventual exit might actually come from a large corporate looking to acquire that startup who's now gone to a Series B or Series D, maybe even further. Do you see that trend now becoming more sort of commonplace in India? Do you feel that large corporates of India might want to actually buy at some stage large startups to sort of and see value add in their own business?
Sorry, your question was again? Your voice is echoing.
Okay, so is this better? Is this better? All right. So I'm saying that, do you see in India this becoming more commonplace that large corporates, or let's say even large family businesses, they might see value add in a startup which has grown very large and might be the final sort of exit for the startup? Do you see this becoming a common norm?
So we've had interesting discussions with, so there are two, let's say, corporate buyers. One is international corporate buyers, and the second one is Indian corporate buyers. As far as the international corporate buyers is concerned, if you look at the three contiguous large markets in the world, which is US, China, and India, China still does not allow free entry of international players. It's controlled. So to that extent, to many international players, that market is not there, which means the two large contiguous markets are US and India. So if somebody in the international market wishes India to be a strategic element, which increasingly many people are doing, for them entry is organic or acquisition. I think acquisition there could be higher than what we have seen so far. Walmart, will it lead to more? Time will tell, but there is interest in large acquisitions. I think there's another phenomena taking place right now. The amount of capital coming from China in the last 4 years is actually shot up quite a lot. So that capital is, I would say, partially strategic and partially financial in nature. So we see interest from Chinese capital coming in. We see interest from, obviously, non-Chinese Western capital coming in. I think Chinese capital will move faster, much faster than the Western capital in the Indian market space. As far as and Chinese capital tends to not just buy large ones. Chinese capital tends to buy even small players, or at least take a strategic interest in small players with ticket sizes of anywhere between 10 to $100 million. In one of our companies, they came in with a Alibaba came in with a $50 million check overall. Now come to the Indian buyers. I think Indian buyers have not taken that leap of faith as yet to buy technology companies. And I've had a discussion with many of them which says, I do not understand why this loss is there. Fueling growth at 100 to 200% per annum would mean that you spend more capital and the company will continue to be in a loss overall. I think Indian corporates, rightfully from their point of view, they've not used such large chunks of capital to build their own businesses. So I think they will not buy large businesses. They will tend to buy small businesses and grow further, which I think in the short run is actually not a bad idea. I don't see Indian businesses spending 500,000-600,000 crores in the technology space as such. I think they're okay in inquiring about smaller companies. So that scenario, will it change in the next few years? I don't think so. I think Indian industry still has to come to grips with the fact that should I build it in-house or should I build it out-house? The reason I say this is also the fact that, leave aside consumer companies as an example. IT companies have not bought much in India.
Correct.
And they have oodles of capital lying on the balance sheet. And you find, buybacks and dividends but not M&A.
But why do you think is that?
You should ask the IT companies.
Sure.
Hi. In the context of your observation that valuations will become more challenging because exits are happening faster than before, any advice to you for the young business owners?